Exchange-traded funds, or more commonly known as ETFs, are often recommended for most investors looking to kickstart their investing journey. And for good reason too. It allows an investor to diversify their investments, thus reducing risks for investing in a single counter. However, with literally hundreds, if not thousands of ETFs in different markets, which ones should a passive Singaporean investor look to invest in? Well, here are some low-cost ETFs I'll look at to build a globally diversified investment portfolio which generates both income and capital appreciation simultaneously. I'll also show how I allocate these ETFs in a passive investment portfolio. So let's get started. Now, the first type of ETFs I'll consider will be bond ETFs. Not only for their rather stable payouts, but also because they are a good introduction to investing for beginners. To decide which bond ETF to invest in, look for one that tracks the performance of investment-grade bonds. This lowers the default risk of the underlying bonds, thus ensuring that you receive uninterrupted interest payments and no drastic decreases in the ETF's net asset value. With that in mind, the two bond ETFs that are worth your consideration are the iShares JP Morgan USA Asia Credit Bond ETF with the ticker symbol QR2 and the Nikko AM SGD Investment Grade Corporate Bond ETF with the ticker symbol MBH. Phew, that was a mouthful. So both bond ETFs are listed on the Singapore market, and choosing which to invest in will be down to your risk appetite and your comfortability levels. For QR2, it tracks the performance of USD denominated corporate, sovereign, and quasi-sovereign bonds from various countries in the Asia ex-Japan region. Most of these bonds are investment grade. About 20% are below investment grade or non-rated. On the other hand, MBH slowly tracks the performance of SGD denominated non-sovereign large cap investment grade bonds. In terms of yield, QR2's yield was at 3.82%, while MBH was at 3.22%. The average yield to maturity for QR2 was higher at 5.96% as compared to 3.77% for MBH. For total expense ratio, both ETFs charge a maximum of 0.3% per annum, although QR2's actual expense came in lower at 0.2% as compared to MBH 0.26%. Personally, I'll go with QR2 due to slightly higher yield. I also generally prefer a more geographically diversified ETF as compared to one that's Singapore-centric. However, do note that in terms of fund size, MBH is way larger at SGD 568.82 million as compared to QR2's US 72.55 million. This means that a bid spread for QR2 will be wider and also be less liquid than MBH. While this will have a minimal impact on a passive long-term investor, as you will not be actively trading the counters, it remains good to know information. Moving on to equity ETFs next, this is where things get a little bit more interesting. The first equity ETF I'll look at is none other than STI ETF. Now, before you all take a pitchfork against me for recommending this ETF, hear me out. The reason I'll go for the STI ETF is due to the dividend yield and lower volatility as compared to other popular ETFs like the S&P 500 ETF. As you can see from the breakdown of the Straits Times Index, around 68% of the index weightage is in financials and real estate sectors, which contains popular companies such as DBS, OCBC, and CapitaLand. Now, these sectors are traditionally good dividend-paying sectors, which explains why the STI dividend yield is currently at 4.66%. It's also useful to note that for 30 companies listed at Straits Times Index, the top 10 largest companies make up around 73.2% of the index. Regarding our choice of STI ETFs, you really only got two, either the SPDR STI ETF with the ticker symbol ES3 or the Nikko AM STI ETF with the ticker symbol G3B. I'll go for ES3 as the expense ratio is lower at 0.26% as compared to G3B's 0.30%. Furthermore, ES3 has a larger fund size of SGD 1.5 billion as compared to G3B's SGD 715.59 million. Now, moving on from the Singapore market, I'll turn my attention next to other major markets, not limited to just the US and China, to capture the growth of large global companies. For the US market, you might have guessed it, I'll look at the S&P 500 ETFs, which gives me exposure to the largest 500 companies listed in the United States. In terms of index weightage, around 30% of S&P 500 index is attributed to the technology sector. The top 10 largest companies make up around 32.26% of the index. More popular S&P 500 ETFs include the SPDR S&P 500 ETF Trust with ticker symbol SPY and the Vanguard S&P 500 ETF with ticker symbol VOO. I'll avoid these two as a Singaporean investor. The main reasons will be due to withholding and estate taxes. As the above two S&P 500 ETFs are domiciled in the US, a Singaporean investor will automatically be hit with a 30% withholding tax on any dividend distributions. Furthermore, the estate tax for foreigners investing in US assets can be as high as 40%, depending on the total asset value. This means that unfortunate event that pass away, your total liquidated US asset holdings, which exceeds USD 60,000, would be automatically taxed by the US government. So to reduce the withholding tax to 15% and not be subjected to any estate tax, it's more cost-effective to invest in Irish domiciled S&P 500 ETFs. While Ireland has an estate tax of 33% for assets funds past various thresholds, UCITS ETFs are exempted from such estate taxes. Look at the various Irish domiciled S&P 500 UCITS ETFs. There are a few options that you can go for, with the SPDR S&P 500 UCITS ETF having the lowest expense ratio, and the iShares Core S&P 500 UCITS ETF having the largest fund size. You might have already seen from the list that Irish domiciled S&P 500 ETFs have a unique feature of being able to go for an accumulating version of the ETF. This means that instead of ETF dividends being distributed to you, it's automatically reinvested back into an ETF. An accumulating ETF could be ideal for those who want to save a little of the slippage cost of currency conversion for future investments into the ETF. As the ETFs are listed on the London Stock Exchange, it will thus require a broker that has access to London markets, such as Interactive Brokers. If you don't have an Interactive Brokers account, use my referral link in the description below to open a new account and be awarded up to $1,000 worth of IBKR shares, depending on the amount that deposited into an IBKR account. After settling exposure to US markets, I'll look at emerging markets next. Staying with Irish domiciled ETFs, there are various options to consider based on the index that you want to invest in. For simplicity's sake, I'll look at ETFs that track the MSCI Emerging Market Index. As I intend to invest in a separate ETF that tracks China counters, I'll thus go for the only ex-China option, which is the iShares MSCI EM ex-China UCITS ETF with a ticker symbol EXCS. With this ETF, you'll get exposure to 653 holdings, spanning across various countries, not limited to India, Taiwan, and South Korea. In terms of sector weightage, it's more geared towards the financials and IT sectors, which take up a total of around 58%. For 10 largest holdings, they make up around 31% of the ETF. Wrapping up the equity ETFs, the last ETF to consider will be exposure to the China market. When it comes to exposure to China, we have a few index options, such as the Hang Seng Index, the China A50 Index, or the CSI 300 Index, each with their own differences. All the China A50 and CSI 300 indexes both track companies listed on the Shanghai and Shenzhen Stock Exchange. The Hang Seng Index tracks companies listed on the Hong Kong Stock Exchange instead. This means that there will be considerable differences in their respective underlying holdings. The most notable absentees on the China A50 and CSI 300 Index will be companies such as Alibaba, Tencent, and Meituan. Personally, when it comes to investing in China, I prefer a more targeted approach rather than mixing in Hong Kong companies. Thus, I'll go for the iShares Core CSI 300 ETF with ticker symbol 2846 listed on Hong Kong Stock Exchange. I prefer the CSI 300 over the China A50 as it not only covers more companies, but it also gives me exposure to mid-cap companies. In terms of sector weightage for the CSI 300, financials, information technology, industrial, and consumer staples account for around 67.2% of the ETF. For top 10 holdings, they will make up around 21.5% of the ETF. With these 4 equity ETFs, you'll be tracking the performance of a majority of the world's largest companies. Besides investing in both bond and equity ETFs, you may also want to consider investing in speculative ETFs relating to commodities and precious metals. I'll personally consider precious metal ETCs, which stands for exchange traded commodities, such as silver and gold, as such ETCs are physically backed by the underlying metal asset itself. If you have stomach for it, you can also look into the Bitcoin ETFs listed on the US market. Increasingly, I think there's a place for Bitcoin in your investment portfolio, but my reasons for that will perhaps be reserved for a future video. Because of which speculative ETFs to put money into, make sure you do a research into the commodity itself and also the factors that drive the market price. It's a good practice to not allocate more than 5% of an entire portfolio to speculative ETFs. You can even skip these investments altogether if you're not comfortable with them. Before going into my preferred allocation for passive ETF portfolio, let me just go through some honorable mentions of ETFs. The first on the list will be Real Estate Investment Trust ETFs. Currently, there are a total of 5 REIT ETFs listed on the Singapore market. Now, I won't be going through each of them as it will make this video too long. But for those who are interested, do check out which indexes these ETFs track and also see their respective underlying constitutes. Also, don't forget to consider the total expense ratio for these REIT ETFs too. Now moving on to the next honorable mention will be World ETFs. As the term might suggest, these ETFs allow you to invest in a wide span of stocks in various countries all over the world. Funny enough, if you look at the two most popular world indexes, the FTSE World Index and the MSCI World Index, they do not really cover emerging markets. This means the missing of exposure to China as it's considered as an emerging market. I have no idea why also. To truly get exposure to a whole world index, you want to look at ETFs that track the MSCI All Country World Index, ATWI for short, and the FTSE All World Index. Because of which ETFs you choose, know that US counters will make up more than 60% of all world index ETFs. In terms of the top 10 holdings, they are all major US companies and make up around 19% of the index. Thus, all world ETFs could be a good substitute for the S&P 500 ETF if you do not want to fully concentrate your investment in the US market. Okay, we have now come to the part of the video where I think most people will be curious about, which is how I will allocate an ETF portfolio to the previously highlighted ETFs. A point to note, I'm allocating this portfolio based on the perspective of the 31-year-old individual. So depending on your age and your own risk appetite, you may not want to follow exactly this allocation. Starting with the bond ETF, I'll allocate about 20% of my portfolio to it. For the S&P 500 ETF, it will take up another 30% of the portfolio. Next up, for the STI ETF, it will be 20%, or 15% will go to the China CSI 300 ETF. The next 10% of the portfolio will go to emerging market ex-China ETF, while the final 5% will be reserved for gold and Bitcoin at 2.5% each. Now you have noticed that there is no cash component for my supposed investment portfolio. This is because I generally consider cash separately from my investments, and the above portfolio is just, well, purely investments. So once again, this will be the allocation for the ETF portfolio, and looking at it, I think it's pretty well diversified. Well, let me know your thoughts in the comments below. So yeah, with that, I will see you all in the next video. Goodbye.